Very good evening and welcome to all the participants. We are very happy and happy to see all of you participating in the 145th WiseViews Leadership Conversation. Please join me in welcoming our distinguished guest, Mr. Sudeep Bandopadhyay. Welcome, sir. Good evening to you.
Thank you very much for inviting me.
Thank you so much for joining, sir. I will quickly do a brief introduction and hand it over back to you for your opening remarks. Allow me to share my screen, sir. So these are WiseViews leadership conversations, which we hold on Fridays. And this is the 145th such leadership conversation that we are hosting with Mr. Sudeep Bandopadhyay. He is the group chairman of Inditrade group of companies. And so the opening remarks will be for about 20-25 minutes, followed by Q&A. And I take privilege of introducing the guest today. Mr. Sudip is currently the group chairman of Inditrade group of companies. Inditrade has significant presence in agri-commodity financing, microfinance business, and MSME lending. Mr. Sudip sits on the boards of a number of listed and unlisted domestic companies. Currently, he is the chairman of audit committee for 2 large companies. Mr. Sudip is also an investor in many fintech and other tech-related ventures. He has significant presence in business media through his regular interaction on leading business channels, business newspapers, and magazines. He has also contributed to the most popular magazine of the ICFAI University publications, that is Analyst Magazine. We are very, very happy and thankful to Mr. Sudeep for his outstanding contribution, which is continuing. Thank you very much, sir. I will also introduce a little bit more about his early career. He joined Hindustan Lever and spent 16 years with ITC Limited in various roles, including a long stint as head of treasury and strategic investments. He managed investments in excess of $1.5 billion and all treasury operations, including capital, currency, and money markets for ITC. Mr. Sudeep was also responsible for the acquisition of strategic stakes in multiple companies by ITC. Post ITC, he was the managing director of Reliance Money and also on the board of several Reliance ADA group companies. He was instrumental in leading Reliance Anil Dhirubhai Ambani Group, that is ADA, foray, among others, into financial products distribution, commodity exchanges, money changing, and money transfer. Under his leadership, Reliance Money had aggressively expanded its footprint in India and across the globe. Mr. Sudip is a rank holder, chartered accountant, and a cost accountant with over 35 years of rich and diverse experience in various areas of finance and financial services. He is also a gold medalist from the Calcutta University. His more than 3 decades of professional stint with large organizations has provided him with rich experience and expertise in the areas of finance and financial markets, including equity, commodity, and currency markets, trading, lending, distribution, so on and so forth. Mr. Sudeep was also responsible for the acquisition of AMP Sanmar, through which Reliance launched its life insurance business. Afterwards, Mr. Sudeep was the managing director and CEO of Destimony, a full-service financial organization promoted by New Silk Route, an Asia-focused growth capital private equity firm with over $1.4 billion under management. Wonderful. Thank you very much, sir, once again for joining us. I will take one more moment to introduce my esteemed colleague, Professor Prasad. He heads the academic wing at the ICFAI Group, and he holds 3 decades of rich experience, which includes his stint as an entrepreneur. He holds BTech from IIT Bombay and a PhDM from IIM Kolkata. Welcome, Professor Prasad. Thank you very much. I'm once again delighted to welcome you, sir. Thank you so much for agreeing to spare some time. Today is going to be a highly learned, scholarly discussion and very, very interactive, as sir wants all of us to ask questions, and that we will begin after his opening remarks. Thank you, sir. Please begin your opening remarks. Welcome once again.
Thank you, Mr. Rao. Thank you, Dr. Prasad, for inviting me to join this session. It's an honor and privilege to be here, and I consider an honor and privilege to participate in activities of ICFAI as and when opportunities do arise. And as yes, I do keep contributing to the magazine as well. Today's topic is Indian economy and capital markets. And I wanted to give my perspective of what's happening in India, why Indian markets are so excited, and why global investors are excited about India. We being in India sometimes discount a lot of things which is happening around us because we we don't put that kind of weight behind the happenings, which is all around us. As there's a saying in Hindi, "Ghar ka murgi dal barabar." So we don't understand and appreciate sometimes really what is happening. I will point out few factors which has really proved to be a game changer for Indian markets and Indian economy. And I'm sure all of you understand and are aware of these developments. But looking at it in a very critical manner will enable all of us to understand and appreciate the role these are playing in the growth of the financial markets and, of course, the economy. If the economy grows, the financial market grows. So obviously, we have to understand the interrelationship. Now, what are these factors which I'm talking about, and what are these such great things? I've been working and I had started my career in 1988 with Hindustan Unilever. And from then and now, the moment I close my eyes and think of the infrastructure, what development in infrastructure has happened, I think there is a huge change in the infrastructure scenario over the last 15, 20 years. I think it started with the Golden Quadrilateral Road project. And then on, it picked up really good pace. The current government also has done quite a lot. So what do I mean by infrastructure? By infrastructure, I mean the roads, the rail, the ports, the airports, and the entire enabling infrastructure for commerce. Now, how critical these are can be very easily understood. That sitting in Bombay, when I wanted to go to a small place in somewhere in North India or southern part of India, it was complicated. I had to change flights, maybe drive half a day and then reach. Now there are airports at every nook and corner of the country, and air connectivity has improved to such a great extent that travel and going to and visiting these small places have become a breeze. Look at rail. I think what's happening over the last few years as far as railways is concerned is a game-changing development. Never ever such concerted effort has been made to revolutionize the entire railway network, whether it's the station, whether it's the wagons, whether it's the passenger coaches, or whether it's the electrification of the lines, whether it's the railway tracks. I think every single aspect of the operations of railways is being looked at, improved, and revolutionized. Look at the ports. There used to be only few ports, Kolkata port, Mumbai port, and the Chennai port and the likes. Today, both the coastlines, east as well as the west coastlines of India, are dotted with multiple ports with significant modern capacity to handle cargo. I think this is of huge importance when you think of India in the context of global import and export. Now, look at simple things like road. I already mentioned Golden Quadrilateral, but the road, when I wanted to go from one place in Mumbai to a Pune or a Nasik or a Nagpur, it used to be a long process. Now with the modern expressways coming up, the modern connectivity happening, the bridges coming, the flyovers coming, I think the transport challenge by road also is easing. And whatever we have seen probably is a trailer. I think massive future development is also in the pipeline. Now, when infrastructure gets built, I think the country gets ready for commerce and rapid economic development. We have got that basic infrastructure in place to an extent, and maybe in another 5 years, we will be at a completely different plane. So this is the infrastructure pillar. The second pillar is very interesting. We call it JAM, and it's popularly called JAM. What is JAM? Jan Dhan. Now, I'm sure all of you are aware of Jan Dhan, the initiative under which I think almost every Indian got a bank account of a certain age, got a bank account. It's of tremendous importance for commerce. It's of tremendous importance for all kind of transfers of money and movement of money. The second is A, which is Aadhaar. Now, the identification, single identification of all Indian citizens through Aadhaar, I think is a revolutionary step. And It was initiated by the past governments and been taken to its logical conclusion by the current government. It's a fantastic effort. And M, of course, stands for mobile internet, mobility, whatever you call. I think the combination of this Trinity jam, Jandhan, Aadhaar, and mobility, mobile internet, has revolutionized lending, has revolutionized so many other commercial and economic activity. This entire growth of e-commerce, e-delivery of services, everything has been enabled because today we have JAM. And it is accessible, it is workable, and it's now being emulated by multiple countries across the world. So this is the second pillar we call. The third pillar, which we realize sometime, we don't realize sometime, is the tax simplification. Now, I'm not talking about GST only. I'm talking about direct tax. Now, please remember, and we don't always experience this, and all of us have a lot of grievances with tax, but leave that aside. Look at the tax rates. Today, a corporate pays a tax which is significantly lower than what it used to pay earlier. And if it's a new corporate setting up facilities, they pay even lower taxes. I'm talking about direct taxes. Today, it's surprisingly, individual tax, the tax which I pay and some of the seniors present in this session pay, is much higher than what the corporate tax is. As a corporate, we pay anywhere between 20-25% tax. Whereas as an individual, we are paying much more. Our marginal tax rate is 30, 35, 40, whatever it is. So for the corporates, for commerce, the tax rate has become world-class. This is as good as anywhere else in the world and better than it most other places. Of course, GST again has been a game changer. There are glitches, there are challenges in GST. And nobody is saying that it is perfect, but it has again revolutionized a whole lot of things in commerce. A certainty has come in government revenue, a certainty has come in a lot of other services which are being provided based on GST collections, based on GST payments by individuals and corporates. So this taxation simplification definitely is a pillar, and it's a world-class structure which has been and being put in place. The next point which I'll mention is again very interesting. Look, we had the Green Revolution in the 70s, late 60s, early 70s, we had the Green Revolution. Agriculture took a quantum leap. We all know that. We saw the explosion in the services with the IT companies and multiple other services coming in. And we are definitely amongst the better ones in the world as far as service delivery and services are concerned. But manufacturing was always neglected. Currently, a lot of focus has been put on manufacturing, whether it's the PLI schemes or easy availability of single window clearance. Manufacturing has been given a significant focus. And remember, in India, the demographic dividend, which we keep talking about, is meaningless unless we are able to provide employment, effective employment to the population. Effective employment cannot be provided by services or agriculture alone. Manufacturing is the biggest pillar across the world, whether it's China, whether it's any other country which has provided livelihood to billions of people. It has been through manufacturing predominantly. And the focus on manufacturing is definitely a step in the right direction. I'm not saying it has happened or it has achieved its destiny or destination, but it's a step in the right direction. The final 2 points I will mention is not related to India or anything which we have done or not done, but it has happened. What has happened? China was the fastest growing economy by a yard, by a mile actually. And they are the second largest economy in the world. However, there are certain steps which the government has taken over the last couple of years, which have created havoc amongst companies operating in China, investors investing in China, and also the world at large. The geopolitical tension created by China has resulted in a significant dissonance amongst multiple participants in business in China. And that has provided a golden opportunity for an economy like India, which is at the cusp of achieving a manufacturing breakthrough. I leave it there at this point. Maybe this can be deliberated when we are doing question and answer. But the fact is, The self-goal by China has provided a golden window of opportunity for India to take that quantum leap in manufacturing, which was lagging and which was highly desired. The last but not the least is related to the financial markets. That is, since the time of financial collapse in US and the world over, the 2008-9 challenges, 2008-9 financial market meltdown, a lot of liquidity has been pumped into multiple markets by their respective central banks. Whether it's US Fed, UK Central Bank, Japanese Central Bank, Australian, EU, even India, enough liquidity has been pumped in. So we have been living in an era of easy liquidity from, let's say, 2008-9 till now, almost now. So this has resulted in enough and more money being available with investors for investing. Under the circumstances and based on what all I have told now, what do the investors do? Today, where is the growth? The growth is in India. India is growing around 8%. You give or take 0.5% here or there, depending on whose estimate you are relying on. But the fact is, if an economy is growing of India's size at 8% and no other economy is close by, the only other economy performing reasonably well at their level is US. China, even if they are growing today, people will be scared to go back to China and invest in a big way. Whether the rule of law operates or not is a big question mark. Under the circumstances, the liquidity will definitely and is coming to India. Long-term money investors, long-term investors, structured investors are definitely looking at India. Whether it's through the capital market, primary market, capital market, or private deals. They are looking at India, investing in India, coming to India. So we are probably in an era where for the next 5-10 years, we will see rapid growth in every area of the Indian economy. Now, if the economy is growing rapidly, obviously Indian markets will grow rapidly. Remember, market always discounts the future. So if we are talking that in next year, this will happen, markets will start discounting it now. Under the circumstances, I think it is extremely important for all of us to understand the potential of Indian capital markets and try and benefit from it. Wealth creation happens when you really start believing in your economy and the growth they are providing you. The debt instruments or other passive investment cannot provide you that kind of growth, what an equity can provide you in a growing economy like India. Of course, there has to be checks and balances, there has to be ways, there has to be structured way for investing and a whole lot of other things. But the logic of not investing is not acceptable in today's India. The logic of remaining in the sidelines is not acceptable and it's not good for the person concerned. You need to participate in this growth story to benefit out of this growth, which is coming to India. So with that, I think I will complete my monologue and I welcome questions on anything concerning markets, economy. I'm happy to try and address those to the best of my capability. Thank you.
Thank you, sir. Thank you very much for these opening remarks. I think you have built the basis for which India is growing and the reasons of factors like how infrastructure has contributed to making commerce move faster in terms of rail, in terms of road, in terms of ports and airports, and helping the Indian economy to grow rapidly. That's the first thing that you mentioned. And the second one is the JAM. And the third one is the simplification of the tax. That is what has led to a positive scenario today compared to what it was some time back. And another important thing is the favorable shift, geopolitical shift for India is also helping us to work on and tap into the manufacturing as a segment, and long sustainable growth and employment is created on thriving manufacturing sector. I think that's a very important point that you have touched upon. What has been a dissonance with China is a shot in the arm for India, provided we tap into it in the right time and expand and make sure that we provide gainful employment for a large number of talented youngsters that are living in our country, and therefore work on what has been termed for a long time as a demographic dividend. Otherwise, it will be a wasted opportunity. And of course, there's no reason, the last point that you mentioned, why they should not look at India as a destination for investments from the outside in point of view. I think this has become a good base for us to discuss further and probably take a few questions on all rosy picture on one hand, vis-a-vis certain doubts that we may have. That's one axis. The other axis is Ghar ki murgi dal barabar is the first one, which you yourself mentioned. I think we need to strike a balance and see if truth lies somewhere in between. But I'm sure, based on the questions and based on your valuable responses, we should be able to arrive at some of those conclusions today. This is a very interesting and most valuable session, according to me, in the current juncture. Our own journey into the economic development and the growth needs some experts to sit down and discuss. And this is what we have in the form of you, sir. Thank you so much for being with us this evening. Without much ado, I request Professor Prasad to kickstart the Q&A. The first cluster will be taken up by Professor Prasad. I'll come back for the second cluster. And in the second cluster, we'll open the mic for the participants to raise their hands. And I also want to mention one more thing, sir. We are joined by some very distinguished individuals. Some of them you knew, and some of them probably you have known them subsequently. But people from education, people from industry, people from financial markets, all of them have joined today, and I'm sure they will ask lots of questions. I see their names. We are joined by Professor Mahendra Reddy, our distinguished advisor, as well as several other directors and deans, and people from the financial market space have joined. We are also joined by our ex-colleague, Mr. Vivek Phadke. I welcome all of them, sir. Thank you so much. Over to you, Professor Prasad.
Thank you, Professor Rao. Thank you, sir, for introducing the topic with some of the most important factors which will build up or open up the potential or manifest the potential as we go forward. The first cluster we are going to devote to understanding this entire subject a bit more. We have two terms. One is the economy and the other is the capital markets. Now, just to understand the whole thing in perspective, I'll put in the first question, sir. What are the differences in the way major capital markets globally behave? I mean, are the driving forces behind different capital markets in different countries different? Can you give us some idea about this?
Prasad, I think capital markets world over, the underlying theme remains the same. However, the variables, the ponderables are different in different countries. In some countries, politics becomes important. In some countries, the government is irrelevant. But few points I will say, which is always the market everywhere will consider. One is the prevailing interest rates. That plays a very important role because it's always an arbitrage between fixed income securities and equities. And the choice is in front of all of us, whether you will invest money in a fixed income security or an equity. Now, the equity and the fixed income security has to have less attraction for you to come to equity markets. That's the basic assumption everywhere, and that runs everywhere. Otherwise, why will you come into a risk asset vis-a-vis a risk-free category of asset? So the government security yield, the benchmark yield, in Indian case, the 10-year yield, which is a very important thing, and its movement upward, downward does affect markets. The second thing, of course, is corporate performance. So that is absolutely non-negotiable. Everywhere the corporate performance is tracked, monitored, because at the end of the day, the market works on that. The third thing which affects the market everywhere, and the government the government is responsible, is the fiscal situation. The fiscal situation remains extremely important because that in a way creates the inflation or controls the inflation. So, different countries, different structure of managing inflation. Some of the countries like us and US, they have a separate central bank, US Fed they call, which monitors along with the finance ministry. So they have responsibility on both. So the fiscal situation is extremely important, and that is monitored. Beyond that, I will say that developed markets today, world over, are alike, and there is very little structural difference. Structurally, they are by and large same. And in that respect, I will say India is amongst the top markets world over in terms of adoption of technology, in terms of clearing, settlement. We are talking about T+0, T+1. From there, T+1, we are moving to T+0. So the transaction is done today, settlement will happen today. That's what we are now experimenting with. And that is much, much better than anywhere else in the world. So we are ahead in many, many aspects in India, and we have adopted technology at the right time, at the right place. So the friction in transaction in India, as far as markets are concerned, is very limited. We have friction on the tax, we have friction on multiple other areas, which is unfortunately worse than many other countries. But pure transaction, pure transacting, I think we have a very, very frictionless system as far as Indian capital markets is concerned. Most other capital markets have a lot more friction. When you settle a trade in 3 days, 5 days, that's a delay. That's a friction point. When you have to do a lot of things manually for a trade, it's friction. In India, that is not there any longer.
Thank you, sir, for laying out the dominant factors in different major global markets and also placing the advantages as far as India are concerned. Now, picking up from one of the points that you made here, I will move on to the next question. Now, in terms of potential, currently, how do we situate the capital markets and the fixed income markets, the money markets, the banks? If you have to put some relative size on India and then how it compares to the rest of the world, and then give us an idea of how that gives potential. Can you throw some light on that, sir?
Well, Dr. Prasad, unfortunately, Indian fixed income market hasn't really developed. The potential is huge. Let me put it this way. But unfortunately, in India, that market is very, very shallow, very narrow. It's only a place where the banks are mostly transacting, and some of the funds are transacting. The potential for growing this market is humongous. I can give you an example. In US, the fixed income market is much bigger than the equity market. So, that gives you a relative size. And US capital market is much bigger than Indian capital market. So you can imagine what kind of growth in India fixed income market can happen, provided we do certain things right. Unfortunately, a lot of things which have happened in Indian capital market hasn't yet happened in the fixed income market. Today, you want to, let's say, as an individual, you want to go and buy some government securities. It is very cumbersome. It is not frictionless. Whereas if you want to buy equities, you open an account with one of the intermediaries, and most of them are online now. You can just sit wherever you're sitting and buy and sell shares. And if you have linked to your bank account, money will move from banks seamlessly. Money will come back to your bank when you sell seamlessly. In fixed income, that hasn't happened yet. There are multiple reasons, and I can talk for the rest of the evening about those reasons, how it has happened, what has not happened, but it has not happened. I'll talk about other thing also. Look, in equity market, there are components. There is equity cash market and derivatives market. I'm sure everybody in this forum is familiar with that. And derivative markets is significantly larger than the cash market. The cash market is where you buy and sell actually and settle the trades. Whereas derivatives is you're taking options or futures. Now in fixed income, imagine in fixed income, there is the futures options market, the derivatives, interest rate derivatives has never picked up in India. Multiple times efforts have been made, but it has not worked in India because of multiple reasons. Whereas in US, interest rate derivative market is huge market, interest rate derivatives market. And to ensure that a proper market is there for fixed income securities, you need to have the derivatives market also working. So long way to go, I would say. Unfortunately, in India, that part still isn't working. We need that to work. The sooner, the better. I'll give you one more reason. Because now what has happened, hadn't happened till now. Now the world is looking at Indian fixed income market also. Like at one point of time, Indian equity market was only Indian players. Then the FII started coming. Today, the foreign investors are looking at Indian fixed income market. They want to invest. Indian securities, debt securities are coming in the bond index of multiple large global FIIs. But unfortunately, the market is still not that efficient. We need to make that.
Thank you, sir. Thank you for putting some perspective on some of the segments US relative to India, as well as the potential which is there in the Indian markets in those kind of segments. I'll come to another question, sir, and this is related to governance and security in capital markets. How far are capital markets secure in India vis-a-vis some of the other countries in the world? Can it be manipulated? Maybe there have been instances in the past, but how is the situation today with respect to governance and how foolproof it is?
Well, honestly, Dr. Prasad, nothing is foolproof. If somebody determined to manipulate something with a lot of money can manipulate. But the fact remains that we are today probably one of the best governed markets in the world. We are technologically very, very advanced as far as the capital market is concerned. Anybody trying to manipulate it can be detected by the regulator very, very easily today. So there are checks and balances. So the chances of manipulation, large-scale manipulation is, to my mind, very limited. Now, from time to time, we hear of stories of people trying to manipulate, doing front running, fund managers doing front running, somebody doing some circular trades. These things do happen. These things do happen in even the most advanced markets, including US. And regulators take strong action, and that acts as a deterrent for these kind of behavior. So to answer your question, I think we are reasonably secure. The chances of, wild manipulation, very, very limited. If you compare today with even 10 years back, I think we are, miles ahead in terms of safety and security of markets. In terms of global markets, I think maybe US, UK, and some of the European markets are as secure as in India, I would say. Manipulation happens even there. And there also regulators regularly take penal action. But whether we can completely mitigate chances of manipulation, the answer is no. It is like driving in the road. There are safety. Some people will violate. They do violate. They do get caught.
Excellent, sir. I think you have given a lot of confidence when you compared the kind of governance and the kind of, the probability, the risk or the uncertainty associated with this as much as it can be in the US or the UK. You do give a lot of confidence on this. So the next question, we referred to China earlier. So in terms of the economy and the capital markets, what are the 2 or 3 things which you the lessons which we should keep in our mind going ahead from China?
Well, I think let's look at what China did. China is 30 trillion economy. We are 3 trillion. So China is huge. Let's understand that. And US is $68 trillion economy. China is $30 trillion and we are 3 trillion. So let's understand the size and scale. Now, what China did, China started systematically going after multiple sectors where there were a lot of private sector companies operating and with significant investor interest and investor money. Whether it's all the edutech companies, whether it's the internet gaming companies, or whether it's the e-commerce companies, they started systematically coming out with regulations which kind of stops the business, kind of truncates these businesses in a big way. Now, what happens when you do something like that, where a lot of investors' money are invested, a lot of foreign capital is invested, is that people start losing faith in the system. That tomorrow morning, Mr. Xi gets up and decides to, do something, he will do it. And, there is no certainty that your investment will fetch you return. And how do you extricate yourself out of that situation? It's a very, 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 very unfortunate situation. So they did that on a continuous basis. Second thing which they did was that they pumped up the real estate sector and in a big way. And when the liquidity crisis came, some reason they didn't support this sector. So the investors started losing money big time in real estate in China. That again led to a lot of loss of confidence amongst retail investors and investors locally in China. Now, to your question, I would say the biggest mistake a country can make is that if you don't have certainty of regulations. Today we are operating where this Zoom call is a legal call. Suddenly tomorrow the Zoom becomes illegal. I mean, you don't know what to do. You don't know how to communicate. So it is like that. You can't change the rules of the game once the game has started. You have invested trillions of dollars in edutech companies. And then you say that, no, these companies cannot operate any longer. It's a disaster. So you have gaming companies who are world leaders, producing games, allowing games to be played on their platform. And mind you, these are not gambling, these are normal. And suddenly you say that, no, this is not allowed. You can't allow this gaming to continue. It's changing the rule of the game, middle of the game. You don't want gaming, you don't allow gaming. But once you have allowed gaming, foreign investors have put in money, local investors have put in money. It has become a billion dollar businesses. You can't change the rule of the game like that. So I'll tell you about our experience also. And very honestly, India every time used to tinker with tax, and foreign investors used to ask us, why does your government tinker with tax every year? Why you have to change your taxation system every year? You want to charge 40%, charge 40%, leave it there. But don't keep tinkering with it. That gives uncertainty. When I invest in something, forget capital market. I invest in a property in Hyderabad. I want that property to remain mine. I don't want the government to come in and after 1 year or 2 years, come and say, no, this property is illegal. That's not done. So it is something like that. When it happens like that, the confidence of the investors gets shattered. And it's very, very difficult to rebuild that confidence. Mr. Xi Jinping is trying now. He's meeting investors. He went to San Francisco, met investors. He met investors in Beijing recently. But I can tell you that, it's got nothing to do with my feeling vis-a-vis China or India. It's going to take ages. It's not so easily gained back. People will wait and watch for maybe decades before they start pouring money in China.
Thank you, sir, for giving us some very concrete examples of the China thing, as well as a hint of what has taken place in India, and perhaps, the certainty of the regulations, as well as not changing the rules of the games once you've started playing the game. I think these are the important points that you have highlighted. Sir, next question, in terms of what kind of developments do you visualize further in the capital markets? There are maybe 2 or 3 important things which you think may happen in the next 5 to 7 years, or maybe earlier.
Well, one thing I will tell you, the capital market, Indian capital market needs depth. And I'll tell you what I mean by depth. That's a very critical component. If you are expecting to attract billions and billions of dollars, Indian market needs depth. You can't have 20, 30, 50 companies which are worth investing from a very large investor's point of view. An investor holding $100 billion will like to invest in large companies. So you need to have a lot of large companies which are already listed. Now we need to increase the universe of listed companies, and we need to do it very fast. Investors have already started complaining that you only have 50 scripts which are worth investing in. Why not encourage more and more large companies to come and list? So there are 2, 3 things. One is lots of public sector companies are still not listed. That needs to be listed. Very critical. A lot of private sector companies, large private sector conglomerates are not listed. They need to be listed. So you need to increase the depth of the market. Unless the depth of the market is improved, there will be constraints and roadblocks going ahead. How much can you invest in a Reliance or a Larsen & Toubro or a Infosys or a ICICI Bank? There is a limit to which you can invest. Why these PE levels, PE multiples are becoming unrealistic? To an extent because the universe is limited. So you go, money is going after those same 10, 15, 20 scripts. So I think that is an effort which government is cognizant of, I'm aware. SEBI is cognizant of, and they're trying to do multiple things. They're trying to ease the process of listing. There is a concept of, file prospectus. So you file a prospectus, get it approved and keep it. And unless there is a major change, you can come with an issue quickly. So because people need to be comfortable, they don't need to go through a 1-year process to come out with a public issue. And by then the market sentiment changes. It has happened multiple times. So that needs to be taken care of, and they're trying to do that. Exit, delisting, that's a big, big problem in India. Delisting of companies. And honestly, SEBI has been trying, and they've been trying for last 15, 16 years. Multiple regulations have come to ease the process, but it hasn't happened. They're still trying, and they probably are going to come up with new set of regulations for delisting. It's very important because when you're entering the market, you should have a way of exiting also from a corporate point of view. So ease of delisting is important. So they are trying to do that. One more thing I will say is that rules needs to be harmonized and implemented for everybody, because a lot of things PSUs are not able to do. That doesn't give comfort to the large global investors. So the rules of the game needs to be harmonized between private sector and public sector, like the independent directors. Now, private sector companies have the independent director. They need to have necessarily the number of independent directors and all that. They need to comply. Whereas public sector listed companies are also not complying with that. So these are small niggling issues, which I'm sure will go out over the next couple of years. Here, I don't think it will take 5 years also. It will go in a couple of years. The second thing, important thing, which I think SEBI has already taken the step, that is T+0 settlement, which is important in the global leadership context, because nobody has gone T+0. If India successfully is able to go T+0, it will be a global leader in trade settlement, and that will happen. They've already started experimenting with a handful of scripts. I think provided that is successful, and I'm sure that will be successful, it will be extended far beyond this handful of scripts, and almost all the, at least top scripts will get covered in that T+0 settlement. The third thing I would say is that at some level, I think the process of regulatory handholding for corporates for listing needs to be a little bit better. Today, SEBI has done quite a lot of work. The IPO prospectus is cleared pretty fast, but still, it takes a lot of time and a lot of uncertainty remains. So that handholding process has started. I'm sure that will get accelerated over a period of time. The other point I already mentioned in the context of a different question of yours, the fixed income securities market, and I'm very hopeful. Over the next 5 years, I believe that will become a very meaningful component of Indian financial markets. It's not capital market, but Indian financial markets. That definitely we need, and I'm sure that will happen. And I think that will be a very good thing to happen. We are missing that. We are definitely missing that. A country of India's size, shape, and technological development, and the performance of capital market, it's unfortunate that we don't have a matching fixed income market.
Excellent, sir. Excellent. You have laid down a number of points which are very doable and which you expect will be done. May not be not even a medium term time frame, maybe in a shorter time frame than that. Thank you, sir. At this stage, I'll take a pause and hand it back to Professor Rao for the next cluster. Thank you very much.
Thank you.
Thank you very much, sir. It's been a very interesting listening to you in terms of the way you have analyzed and proposed basis points in terms of logic, in terms of reasons, where we are going and why we are going the positive way. Wonderful, sir. Thank you so much. We'll take a few questions which are a little more rudimentary as keyed in by our participants. The first question, or before I ask the first question, generally it is believed that the projected 8.4% growth of India, annual growth of India, is not actually matching in terms of the other calculations. A part of this could be political, but we'll keep that aside. But the narrative that at best it is around 4 to 5%, but it is being projected as 8.4% annual growth rate. By looking at some of the submissions in terms of the growth of manufacturing companies, growth of consumer products companies year on year, is actually not totaling up. How do you look at this narrative that is 8.4 versus maximum 4 to 5% real?
No, I think, Mr. Rao, I'll tell you something. We have no political views anyway. We are only talking economics hardcore here. And the reality is, as I also said, that look, whether you take 7.5, 7, 8, it's same. But if you are talking about 4, I will not agree to that 4. I'll tell you why. There is definitely a problem in the consumption. And that consumption problem goes deep-rooted. It is in rural and it is now crept into urban also. But look what has happened. The government has been spending heavily on infrastructure, and the capital expenditure by the government is huge. And that is taking care of the shortfall in multiple other areas. There is a statistics which is going around, and I have privy to a lot of these statistics, that we are talking about government is spending more. But if you combine the state government spending and central government spending, it is not more. But what is happening is The government spending is much more targeted and much more efficiently being handled today because of whole lot of things which has happened. And some of these I mentioned already. So the targeted and efficient spending of money is leading to a multiplier effect in the economy. There is no doubt about it. Now, what is the problem and whether this is sustainable or not, I also will to an extent agree with you that unless consumption picks up, and somebody asked me this question in one of the sessions with CNBC, that why is private capex not picking up? The private capex, you can keep saying private, call the industrialists and keep telling them, boss, invest, but they are not going to invest unless there is a demand. Private capex will only pick up when consumption demand picks up. It is no magic. It will pick up when consumption demand picks up. Because consumption demand is not picking up, private capex is not picking up. Yeah, infrastructure is happening. PPP projects are happening. Somebody investing jointly with government for a infrastructure project, that is happening. But consumption demand is related to private capex, and that will not happen unless consumption demand picks up. So yes, we need consumption demand to pick up. And if the consumption demand picks up, I believe this 8.4 will be sustainable. Also remember, the growth is year-on-year growth. Now, we had bad growth in last few years. So on top of that, sometimes this 8.4 looks good. But we have to remember, next year, we have to sustain growth over the current year. So 24-25, we have to demonstrate a growth above what we have achieved in 23-24. So here the challenge is government capital expenditure plus private capital expenditure, and consumption has to pick up. Then only we will be able to achieve the kind of growth rate we should be achieving or we are aiming to achieve. If you look at the RBI data which is coming out, they are not talking about 8.5. Next year growth projection, their growth projection is significantly lower than 8.5. It is the reality. That is the reality. We still, and even there, they are assuming that consumption is picking up. Inflation is coming down. With that, they're projecting around 7% growth.
Excellent, excellent. Thank you. Thank you so much. But the points that you have stressed upon are three. The public expenditure, private expenditure, and the consumption demand are required to go up in tandem. And then we could have sustained the projection of the growth that we are talking about. That's the take-home point. Thank you so much, sir. Sir, there are other indices. I don't know if it is related to this discussion, but I'll just mention it and you can comment and we can go back to the next question. Other indices like happiness index, other indices like employment, other indices like per capita income. A large number of people in a World Bank report recently, we have seen a large number of people in India have an earning which is less than or equivalent to $5.50 per day. That is alarming. I mean, if that number is true, these days we are getting confused between lies and statistics. But assuming that it is correct, it is alarming. And some of these ancillary indices and indicators will also talk about our country, whether it is really growing or not. You can help us interpret it and try and bucket it the way we should look at it.
No, absolutely right, Mr. Rao. I think, if you look at Bangladesh, the per capita income of Bangladesh is much higher than per capita income of India. Now, Bangladesh was a basket case at one point of time, and from there they have gone. And that I will come back to my argument on manufacturing. See, you can gainfully employ a significant amount of population if your manufacturing sector grows. Without that, there is no hope of you to ensure that your your country's economic prosperity, per capita income goes up. It cannot happen. And that's why I mentioned that manufacturing focus, which the government is trying to bring in now, is very, very important to improve that per capita income. China, how did the per capita income go up? That is the manufacturing focus. With agriculture, you cannot go there. And service is very small. Remember, we have seen excitement in Hyderabad and Bangalore and this and that, but that is only a fraction, tiny fraction of the population who can be employed there in services. Manufacturing has to be there. And in a country like India, the most populous country in the world, if you don't have strong manufacturing, you are destined for a demographic negative dividend. You are destined for that. So you have to be careful about that. So some of these statistics which you are talking about is absolutely correct. There is no two ways about it that there is a disparity of income in India. There is a significant rural-urban divide. All that is absolutely correct. But I also believe, and I've seen this happening in multiple countries in the world, there's a trickle-down effect. Wealth does trickle down, but we cannot sit here and hope for that trickle-down effect to lift everybody out of poverty. So we have to push manufacturing. We have to push a whole lot of other things, which is why I completely agree with you. And I think we need to do a lot more. And end of the day, honestly, I personally believe that only when we have received a certain level of per capita income, we can say we have done it. 3 trillion GDP, 4 trillion, 5 trillion GDP doesn't take us there. It can happen by some sectors, some people doing too well, and other sector and other segments in abject poverty. And we should not be there. We should try for a balanced development.
Thank you, sir. Thank you so much for your interpretation and helping us to understand this balanced approach and balanced growth. All other indices will have to move in tandem. And that's when India would have really, really grown. Thank you so much, sir. I'll quickly go to the first question that I wanted to take up. And that is, one of the participants wanted to seek your views on this point. The predictions of Sensex reaching 150 points in 2029, is it realistic?
Look, predicting the future is always like astrology. So I can't comment on whether it's 150 or 130 or 170. But look, if you ask me whether the economy and the markets will grow, the answer is yes. There are every possible ingredient for us to grow. Unless there are some honestly massive external factor which disrupts everything. I think we are on a growth trajectory. We are on a strong wicket as far as both macro and micro factors. The destiny is helping us. This geopolitical stress, which is positive for India and negative for China. The entire China self-goal is definitely positive for India. These are things which we didn't do anything. It happened and it should benefit us, provided we do it right. We have done a lot of things right also over the last 10, 15 years. And that should gradually start helping us. So my point is, we will keep growing. The economy will keep growing, market will keep growing. There will be steady, stable growth of the Indian market. Now, what can derail this? I'm taking 1 more minute and telling what can derail this. We are, end of the day, still a major oil importer. The biggest component of our import is oil. 70+% of our oil, why 70? Close to 80% of our oil is imported. Now, the oil prices going beyond a certain level definitely disturbs us big time. Economy, market, Sensex, Nifty, everything. So please remember, and remember one more thing, oil price is beyond everybody's control. Nobody in the world can control. They can say multiple things, but whether Saudi Arabia can control, no. Russia can control, no. Nobody can control. It's got so many factors nobody can control. As long as oil prices are under control and there are no major calamity, I think we will keep moving upwards. And yes, someday we will reach there. 1 lakh and 150 will reach there. Whether it's 29, 30, 28, I don't know.
Thank you, sir. Thank you for the word of caution that we should, of course, uncontrollable oil prices is a possible threat or a possible factor that can derail the growth trajectory that we are talking about. Thank you very much, sir. The next question is, one of our participants wanted to understand how these capital markets provide opportunities for CAs, CFAs, or NDA finance students. What kind of opportunities that they can expect and foresee in the next few years?
Multiple opportunities. I think the world is, your playground as far as when you are doing CFA from ICFAI, or you are a CA, or you have some good financial degree. I think end of the day, finance is the core. I probably am a little biased. Engineers will not agree, but I'll be very clear. End of the day, it boils down to finance. You may learn engineering, and of course we need engineers. Of course we need all other professionals as well. But end of the day, it's money. And finance guys understand money. You should understand the financial mechanics and the economics. These two things you need to understand, and you are valuable for the financial sector. Whether it's banks, whether it's capital market participants, whether it's a research house, whether it's a asset management company, life insurance company, everywhere. I think the world is your playground, I would say. Why India? Globally, global financial markets should be your playground. So please don't worry. I think there are enough and more opportunities. Whether it's you can become an analyst, you can become anything. The financial market needs financial players, people who are financially advanced, financially trained, and you guys are going to be. So I think the demand is huge.
Great, sir. Great. Very reassuring. There are lots of opportunities. In fact, there's a groundswell of opportunities.
Absolutely.
And the world market should be your playground. I think that is very interesting. Sir, I'll request now, we'll take a question from the audience. Dr. Anita wanted to ask you a question.
Sure.
Requesting Dr. Anita to raise her point.
Good evening, sir. So I had the good fortune of listening to you for the second time. One was when Dr. Kaushik had invited you for the MFI talk. And thank you for having a very, very comprehensive overview on the capital markets and financial markets. So I had one small question that is relating to debt markets. You had very well pointed out that fiscal management of the government is very, very important and crucial. And that determines the economy's, fate in the coming years. So in that context, I just wanted to understand, when we look at the debt markets prior to 94, 95, where we had, very liberal way of government spending, which was not controlled. And indirectly, if you were to look at our, fiscal expenditure that's being funded by the, let's take government for sake, they were using RBI's ad hoc T-bills and then they were converting into long terms government dated securities, and where the rates remained very, very low and it was unliberalized. The systems where the interest rates were quite administered rather than being free flow. Now, to what extent did that contribute to the debt? I would say in that regime, if you were to look at the corporate debt segment, was quite ignored because the expectations were on the little higher side, while our ranges were between 4.68 to 6% over a very large period of time, and then you could see that rates easing in the last decade or so, which came to close to 9%. So your perspective on that corporate debt segment. In fact, Rangarajan sir, when I asked, he also said the same thing. Although we did a lot of work to revive the corporate debt segment, that didn't take off really. So what do you think that could be some of the clues or key takeaways where the corporate debt has to work on itself and then
See,
so that we reach on that? Thank you.
Dr. Anita, I think it's a very valid question, and this is one of the unfortunate things in Indian markets, financial markets. The debt market isn't functioning, and debt market hasn't functioned. Today you can't, you and me, and if we want to buy some debt security, we just can't buy. It's such an unfortunate thing. Corporates need money, and corporate requirement of funding cannot be and should not be met by banks only. It should come from issue of debt securities, but that's not happening, and it's very, very unfortunate. See, the entire, pardon my saying this entire thing started happening when overnight RBI removed the intermediation from this debt market. I don't know whether you are familiar. Intermediaries were allowed to participate earlier. I'm talking about early 90s and all that. And the market was moving in tandem with the equity market. Then for some reason, I'm sure there are valid reasons, RBI prohibited intermediaries from being there. So it is a bank-to-bank dealing or a direct dealing. Now that killed the market overnight. I mean, that market disappeared just. Today, if you imagine that all the brokers from the equity market will be banned, I don't know how the dealings will happen, how things will move. You will have to directly buy securities through the exchange, some platform and something like that. So RBI tried quite a lot by introducing platforms and a whole lot of things. Later on, some kind of intermediation is being permitted, but still, I think it is something which has never taken off since then, and it's something which is a crying need, if you ask me. And that's why I think when I was asked by Dr. Prasad that what do you think should happen in next 5 years, one of the things I said that debt market has to function. If we call ourselves a developed financial market, without a, we can't call ourselves a developed financial market without a debt market which is functioning. So we have to get that right. Now, there are multiple reasons. See, interest rate derivatives. Now, that's again a very, very important thing. And I can tell you it is important because I used to manage large treasuries on behalf of corporates, whether it's ITC or Reliance. Now, I don't have an interest rate derivative instrument which I can buy and hedge my risk. Interest rates keep changing, and I have no option of doing that. Today, I'm stuck. I borrow from a bank at X rate, and I'm stuck there for a 5-year loan. Now, the interest rate in the economy has come down. I know it's going to come down. I don't have the option of doing something. Now, these are not really signs of an advanced market. And if you look at US market, I think interest rate derivative market is even bigger than debt market. The largest market is interest rate derivative market. Next is in the debt market, pure debt market. The third or fourth will be equity market. So I agree with you. There are a lot of things to be done. Honestly, I don't know beyond this what I'm saying, what can be done to set it right. But it needs to be done, and there needs to be solid thinking behind put behind this to ensure this functions. I can tell you the corporates will be the biggest beneficiaries if this market is revived. So will be the government. Government can raise money. Government is now trying. They're saying, RBI is saying that you and me can try and buy government securities directly. But who does that? Nobody does that. How can I do? I don't know. I mean, it's being talked about. I don't think anybody has done it. So it is required. It needs to happen, but it hasn't happened yet.
Thank you so much, sir, on your perspectives. And if you could also highlight, I definitely agree that, interest rate derivatives, are no way visible in the, any of these balance sheets of the corporates because they are not available. And until you manage your interest rates well, you would obviously be, you'll not have hands-on to protect yourself from the, risk that is coming up.
Yeah, we are operating at a suboptimal level in spite of knowing that we are operating suboptimal.
And I would also wish to know your perspective on, the LIBOR scandal has happened and how far we were able to, start a new benchmark for, Indian derivatives, especially in the short term. Although we have MIBID and MIBOR coming up, and Sonia, and there are various other rates. Your views on that?
Well, I think we are trying, but we are nowhere close. I can tell you, Dr. Anita, that we still track LIBOR and we benchmark to LIBOR, and all transactions still happen, with reference to LIBOR. Yeah, I mean, all large transactions, cross-border transaction, everything. I mean, LIBOR had become such a benchmark, and it was very unfortunate that that LIBOR scandal came to light and, whatever happened. But there is nothing parallel to LIBOR, unfortunately. And it's a long way to go before we can get something like that. I'm not sure whether we'll get in a hurry that. I'll give you an example of, US dollar is the now standard currency for everything. And a lot of people talk about, the Chinese yuan will become, Indian rupee will become, something else will become, but nothing has. US dollar continues to be, so LIBOR has become like that. I mean, it's very difficult to replace. Yeah, some deals happen on MiFID and this, that, MIBOR and all that, but those are small. Large transaction, global transaction, all LIBOR.
Thank you, sir. Thank you very much. Thanks, Dr.
Thank
Anita,
you
for
very
your
much,
introduction. Thank you. So we move to the next one. I request Mr. Neelam Murli to ask his question.
Sir, I'm in a hotel here. My apologies. The point which I want to, first of all, my sincere thanks to you for your wonderful insight, Mr. Sudip, for coming online. Thanks to ICFAI for organizing this. We are very much grateful to you. I'm actually a big dreamer. I request you, it may not be the right question, but I seek your guidance. Is there any way can we become the largest economy as US? You said $60 trillion or $68 trillion economy they possess. Yeah. And can largest economy in coming times. I read somewhere actually in services we are scoring very well more than manufacturing, and any knowledge is less. If any possible input is there, kindly just ask your guidance. Thank you very much for your valuable time.
Yeah, of course it is possible, but it is a long way off. Honestly, very honestly, we would all wish it can happen quickly, but it is some distance away. I'll give you an example and you'll understand clearly. China, from the late 80s till a couple of years back, so let's say 2019, let's take. So let's take Tiananmen Square, that was 89, 99, 2009, 2019. 30 years of development, 30 years of continuous hard work on the economy took us to 30 trillion. They are 30 trillion, vis-a-vis US 68 trillion. So we should not feel bad that we are 3 trillion. We started from a much bigger handicap. Now we are growing, and believe me that 1 trillion to 2 trillion, the time it takes, 2 to 3 takes much less. 3 to 5 will take much lower time. So the growth happens in a much rapid pace. And that's what will happen in India. That's what happened in China, and that's how it happens. Now, for us to cross US, you have to assume also that US will remain static, which will not be the case. Hopefully, for the sake of the world, because if US remains static, US doesn't grow, then we have all of us have a problem. So US also will grow. US probably will, let's say 10 years down the line, or let's say 2050, which some of us are talking about. 2050, we become 30 trillion. Let's hope that. By that time, US probably will be 100 trillion plus, if not more. So the goalpost will move. But if we continue our progress the way we are progressing, or we should progress in few years, yeah, at some day it will be possible. Definitely possible. I give you the example. 30 years, China has gone to, from was like India, and they've gone to 30 trillion. So maybe 30 years. So today we are at, let's say 2020, 30, 40, 50. So about 27, 28, 26, 27 years, we can go to 30 trillion.
Great. Thank you very much, sir. That's a very positive, very optimistic, and believe in yourself and keep working at it. Example is the hard work of China in the last 3 decades that led them from being where we were, probably parallelly, and now today to 30 trillion economy. So answer that you provided is yes, we must believe in ourselves and keep pursuing it. That's a hard work, but it is possible. Thank you, sir. I'll request Mr. Jitendra Srimali to ask his question.
I would be very grateful if you could point to some online resources where novice could get started and learn this subject. I mean, you have made it look so simple. You've been so articulate, but where does a novice start?
Well, I think there are multiple sources, very honestly.
Something that you would recommend, sir, because I mean, it has to come from a very credible source like you.
So, sir, knowledge is on 2 areas, I would say. One is economy. The other is the financial markets. Now, these 2 are linked, these 2 are related, but the source is different. The economy, the knowledge will come, I mean, to be very pedestrian, but very simple and straightforward. I will say, if you start reading some of the good journals and newspapers, a lot of good articles, a lot of good discussion on economy does happen. Even a newspaper like Economic Times, which is there everywhere, start reading, I would say, the editorial page. A lot of interesting, good article on economy and macro subjects do get discussed. You can pick up Financial Express for that matter. You can pick up some other newspaper for that matter. I think all of them try to do that. My favorite, and I've been reading for many, many years, is a global newspaper, Financial Times. If you read Financial Times or access Financial Times online, I think you don't need to do anything else. It is fantastic. It is the #1 newspaper in the world actually for finance and market professionals. So Financial Times is something which you can read. As far as specific market knowledge is concerned, I think some of these sites, including Money Control, including, let's say, ET site, they are good sites. You can get a lot of market-specific knowledge, whether it's corporates, whether it's what's happening in the market-related news, that you can access. What is important is getting a holistic perspective. And I think some of these good journals and newspapers will give you. I mean, don't get into the bias of, everybody has a bias. So you forget the bias. You focus on the matter at hand. I think you will be able to decipher yourself what is the true meaning and message.
Excellent, sir. Excellent. Thank you very much. Your advice that we should keep our bias aside and pursue knowledge and go to the right resources as indicated by you. FT for economy related and several other portals like Money Control or ET for market specific information and knowledge. Wonderful, sir. We have noted that down. Thank you so much. I will now request Mr. Pradeep to raise his hand. Over to you, Mr. Pradeep.
Thank you, sir. Thank you for a highly engaging session, knowledgeable section. My question to you is slightly different. I think we have not touched this. Do you foresee in near future, say 5 to 10 years, cryptocurrency becoming mainstream, being accepted as a medium of exchange?
Well, honestly, I am not a crypto guy. I don't believe in crypto. I'll tell you why. So I'll tell you why. And please don't misread me, because today's youngsters and young generation believe in crypto. See, if something doesn't have an underline or a backing of a sovereign, I am very skeptical. Honestly, probably being a Buddha, you can say, but I'm skeptical. The currencies of any country, even if a small country, it's a central government backing. So there is something behind it. Earlier, the countries used to have a gold standard. They used to be backed by gold. So there was some backing, some private individual, issuing cryptocurrencies and storing it in, all kind of, places. We have seen enough accidents already in the last few years. Look, conceptually, I agree. The blockchain concept is a great concept. So I have no problem with blockchain, and I think that should be adopted in multiple areas. Why only currency? It can be adopted in multiple areas, and it is being adopted in multiple areas already. So that's a fantastic innovation and fantastic thing to have. But currency on top of it, which is unregulated, which is, not backed by something, issued by some private entities, I find it little complicated and little hard to have my faith in that. I'm being honest with you.
Thank you, sir. Thank you for your opinion.
Not backed by the sovereign. Yeah, we'll go to the next question quickly, sir. This is from Ms. Chitra. If you're ready to ask the question. Yeah.
Yeah, very good evening, sir.
Good evening.
First of all, thankful for giving me this opportunity. And sir, you have really projected the Indian economy development in a very rosy way. Rosy picture, I should say, you had brought down. No doubt the development is happening. Like you have said, the transportation and all the infrastructure development which is taking place. But still there are certain areas, I can give my example, that every day, I think it's last for 1 year, just 8 kilometer distance, we take approximately more than half an hour, just 8 kilometer. And just within a span of 5 months, I have to change my car tires twice. This is the real condition which is there in our country. And I think the development which is being taking place, which you are saying, is just 1/4 part. And maybe the metropolitan cities or UTs like that, because the ground level scenario is totally different, which we see. So it's a huge applause to the Indian economy's growth if it is really happening. So my question is just that what I see, there is a gap. And why this gap is there, and who is responsible for that?
No, you are right, Chitra, and I can understand your anguish and frustration over the challenges we face on a daily basis. But I'll tell you something. Look at it this way. Today I came and entered the office there are 2 doors to my office. I use the left door. So if you come and question me, why didn't I use the right door? I don't have an answer. And tomorrow I enter through the right door. Mr. Rao asks me why I use the right door. I don't have an answer either. I mean, see, I have to start somewhere. So you have to start somewhere. So I think in a big way, and honestly, it's got nothing to do with present government, present dispensation or the past. I think originally the infrastructure development started during the Atal Bihari Vajpayee regime, golden quadrilateral. Then it was carried forward by the Manmohan Singh government, successive Manmohan Singh governments. And that is being carried forward by this government. And believe me, I mean, whichever government comes, once this momentum has gathered pace, it will continue. I face the same challenges as you do in sitting in Bombay. But believe me, and I can give it to you in writing, in 5 years, Bombay will be a different city. With the kind of infrastructure development that is happening, it will be a different city. Yeah, challenges will be there. We are a large country, populous country, so commute and those challenges will be there. But the fact is, infrastructure is being built. I'll tell you something. I used to be based in Kolkata. For reaching to a place like Madurai, I had to change 2 flights. Now I go directly to Madurai. See, every place there are airports. I've seen in front of my eyes. I've seen Hyderabad airport. It used to be a small airport in that that Begumpet, and honestly, it used to be full with mosquitoes. And I'm talking about 1986, 87. We used to be scared sitting there. And now look at the shining, bright, nice airport. Every place it has happened, not only here. So development is happening. Development will have its pain. Half the roads in Bombay are closed, dug up. So we have the pain. So we are going through that painful phase of development. But I think what is happening for the good. Everything can be looked at it positively and negatively. So my request will be, look at it positively. Let's have faith, not in any individual or any party or anything, in the process. I think that should give us the hope to continue doing what we are doing in a better manner.
Yeah.
Excellent,
Thank you. We
excellent.
are hopeful, sir.
Thank you very much for your patience. I think we need to have faith in ourselves, and we need to believe in the process called India. I think that's a WIP all the time, and it's growing. Let's have faith in our country and hope that we grow as one of the largest economies in the world. From where we are to the targeted, I'm sure it will take some of the trials and tribulations for us to overcome. But definitely, there are examples in the world, in the countries around us, which have pursued these goals, and we too can do. And if we are together and if we believe in ourselves, we can do it very well. Sir, I will request Dr. Kanaka Sudha to take this question, and this will be the last but one question, sir.
Good evening, one and all. Am I audible?
Yes.
Yeah, you are.
Yes. Thank you. I'm just a novice in capital market and getting a grasp of all the concepts that you have delivered today, sir. And kindly excuse me if my question happens to be too amateur. My question, probably a series of questions, a couple of questions. There is a lot of brouhaha in the current situation stating that youngsters are jumping into the stock market and capital market. And also the reports, some survey reports are stating that youngsters are not taking informed decisions. So how is this going to have an impact? That is question number one. Question number two, suppose if the current youngsters are having informed decisions and entering the capital market, within what span of time can we reach the so-called trillion economy that we have been talking about all along, that we are in 3 trillion economy and China is 30 trillion. How fast will we be in a position to reach, if not give a big leap, at least to some extent, will we be in a position to raise with them?
Okay, excellent. No, your questions are not at all like a novice. I think you understand quite a bit. I must say, Dr. Kanaka Sudha.
Thank you.
Look, I think participating in capital market is definitely the way forward. Not participating is not the right thing to do, whether it's a youngster or even people like us. A part of your disposable income should be allocated for capital markets. That is what I strongly believe. I'm not talking about people who are in their 70s or 80s. That is their choice. But till the time you are earning, I think definitely a part of it should go to capital market. The logic is simple. I'll tell you in 1 minute. Indian economy is growing. We all know that. We can keep debating about the figure, whether it's 6 or 7 or 8 or what is the statistics here and there. Let's take, we are growing at 6-7%. 7%. Let's take the example. And what is the inflation? Inflation, let's take at 4-5, whatever you want. So that makes the nominal growth at 7 plus 5, 12%. Now, 12% growth of the economy will ensure that if you have picked up the right stock, right sector, it will be better than even 12%. But even at 12%, it is far better than a debt instrument. So my point is, today, participating in the Indian economy through the capital market is definitely the thing to do. Now, your question of without understanding investing in the market, of course, that is not correct. So we always recommend that they should come via the mutual fund route, which are managed by experienced fund managers, and gradually move to directly investing once they have gained adequate knowledge. So please communicate this to everybody you interact with, that they should definitely participate, but participate through the mutual fund route. Or if you wish to seek an advisor, get a consultant who understands the market and properly advises them to get it. Definitely they should not go into it as a casino, just buy something, sell something. That's not right. That, of course, is not right. That's not the right approach.
Thank you very much, sir.
Thank you.
Thank you, sir. The last question we will take from Ms. Shweta Anand, the gold question. Yeah.
So, sir, a very good evening. So my question is on the metal, the yellow metal the nation is so fond of. And at times, mostly it lands up in the lockers, bank lockers or house lockers, or people just, walk on the street wearing heavy chains and jewelry. Though it has huge potentiality to transform our Indian economy, though we have now sovereign gold bonds, and there's a lot of gold which gets exported as well and gives employment. But what are the other ways in which this metal can be tapped to boost our Indian economy further?
Well, let's put it this way. The gold bond is a very good way of investing as far as individuals are concerned. There are gold ETFs, but gold ETFs are inferior compared to gold bond. In a gold ETF, what you are doing is you are not getting any interest. You are only getting the appreciation on the gold. And you are also paying a charge to the fund manager to manage the money on your behalf. So you are getting gold appreciation minus something. Whereas when you are investing in a gold bond, you are getting 2% interest plus the gold appreciation. So you are better off investing in a gold bond. You don't have to handle the physical gold. You don't have to carry around. You don't have to do any of that, but you are better off investing in gold bond. So that's one point. But your bigger question is, how can we use the gold for bettering Indian economy? I think Indian economy is rich. One of the reasons is we have a lot of gold. There's no two ways about it. And we don't export gold. Please don't be under that impression. We import gold. We are amongst the largest, sometimes we are the largest importers of gold on a yearly basis. And government wants to stop that and encourage people to circulate the gold internally so that we don't have to keep importing gold. But we actually import gold. Now, there is no actual physical use of gold as such, other than, women wearing and enjoying it and men appreciating it. But the value, gold has been for thousands of years, the store of value. So as such, if you have gold, you are strong. That's the notion, and it's a correct notion. Every country's central bank buys gold as a store of value. So whatever reserve RBI has, and you must be reading about it in newspapers, a part of it is in gold. Chinese central bank now is heavily buying gold because they don't want to keep US dollars. They want to keep gold rather than US dollars. So that's the currency. Gold can be termed as a currency, default currency. So that's how people use it. But actual use of gold to do something, very difficult, very difficult. Store of value, yes. As an investment, great idea, buy gold bonds.
So will this be the right time to buy some gold bonds?
Oh, well, gold bond is always the right time because, see, look, I won't encourage you to speculate, buy and sell gold bond. You buy and keep it. Keep buying gold bond at every opportunity when you can. There's absolutely no problem. And if you look at the gold, the way it has moved over the last 10, 15, 20 years, it has kept moving up. And it is a very interesting thing. Capital markets and gold has moved in tandem. If you look at a 10-year chart, you will see both have moved up. And it's got something to do with liquidity. If you have enough liquidity, I'm sure you will allocate part of it to gold, part of it to capital markets, and part of it for other things.
Thank you, sir.
Thank you.
Thank you. Thank you very much, sir, for your patience. So you have taken all kinds of questions, and I'm deeply thankful to you for that. Before we wrap it up, may I bring in Professor Prasad? He has any last question, one for the road?
I think all have been covered in different ways. Thank you very much.
Thank you. Thank you very much. Sir, this has been a very enriching discussion over the last 90 minutes or 90 plus minutes, out of which You have very generously shared more than 90% of these 90 minutes for conversation, for questions and answers. I'm actually delighted you have spared so much time for us, especially for Q&A, because Q&A clarifies a lot of things and so many people are involved. They're watching us on Zoom directly and also on Facebook Live this evening. I'm sure immensely benefited by your responses, clarifications, interpretations and all. There are many, many takeaways, but top of the mind, 2, 3 are that first of all, believe in the growth story of India. We must believe because we belong here and it is growing. We can see that. Despite some iniquities, despite some hiccups here and there, and despite some roadblocks, I think our belief to surge ahead is extremely important to start with. Second, irrespective of any government, I think the growth story is being pursued very passionately over the last 2 decades, beautifully in a deserving manner. And I'm sure infrastructure majorly shines, and absolutely there's no doubt about it for anyone, even for the naysayer, the infrastructure is a very, very big push. And I'm sure that becomes the basis for conducting commerce, trade, and economy, thereby getting a boost. And several other measures that we have seen, as you listed in your opening remarks, is very, very instrumental in shaping the economy wherever it is. $3 trillion economy itself has come after a long struggle. And the fact that you have analyzed and helped us understand it is moving in the right direction, I think that's a very, very important takeaway. The other thing is that youngsters should definitely get into these capital markets. Everyone should get into the capital markets. Instead of making it a spectator sport, I think it should be a participative exercise. And if the knowledge has to be enriched, that may be borrowed from very good sources, as you mentioned. We need to focus on developing our knowledge on economy-related matters as well as market-specific knowledge by relying on specific sources, as you mentioned. With that knowledge, we can get into the capital markets. And when the knowledge is short, probably we can enter through experts' help, through MF route. And I'm sure we, instead of staying aside and making a commentary, I think we should participate and see how it is evolving and shaping up. Then we will be writing our name in the growth story of India. Otherwise, we will be only making comments on social media. I think that's one big difference. Thank you so much for your patience listening, as well as very, very patient response to a variety of questions that we've asked. Questions that bordered on politics, questions that bordered on disbelief, questions that bordered on extreme pessimism sometimes, but an intellectual discussion would have all of these put together. And you have played the anchor role in helping us get through all these questions. Thank you so much, sir. This will remain etched in our memory for a very, very long time. I would, on behalf of all of us who have participated today and on behalf of ICFAI Group, it is your organization, ICFAI Group. We thank you so much for this expertise, time, and energy. Thank you so much, sir.
Thank you, Mr. Rao. Thank you, Dr. Prasad. Thank you.
Sir, we will make a summary of this session. We'll share it with you for your inputs. And once you approve it, we will put it on our archives for others to go back and learn from it. There's a video as well as a text summary, both we will keep.
Thank you. Thank you.
Thank you so much, sir. And one note before I leave for all the participants, we will meet you next week on 19th of April with yet another veteran, Mr. V. Sankaran, a veteran from ICFAI again, but he was there in the founding years with us. He's going to talk about independent directors and the emerging role in the corporate governance of because of these independent directors. It is a very interesting subject. We are going to have this on 19th of April at 6:30 p.m. Till then, read more about financial markets, read more about capital markets, read more about Mr. Sudeep Bandopadhyay. I think there's a lot to learn from him as well. We look at his articles in magazines. We read his publications. It will be very interesting for us and also a big help for us to understand the dynamics of these markets. So thank you all. I wish you all the best and have a great weekend and see you next week on Friday at 6:30 p.m. Good night.